Hello, everyone, and welcome to our monthly ScholarCAST. The ScholarCAST today is Understanding Your Student Loan Options. We will get started in just a minute or two as we have more people coming into the presentation. And our speaker, Bill, is getting ready here. So we will be getting started in just a minute, everybody. Okay, let's go ahead and get started. Welcome everybody to the June ScholarCAST. My name is Evan Weisenfeld. I'm the Vice President of Growth for NSCS. Joining me today is Bill Ayers from College Ave, A Better Student Loan Experience. This is the ScholarCAST for Understanding Your Student Loan Options. I'm excited to turn the camera over to Bill, and he's going to walk us through some really useful information on understanding how you might consider funding your college education if you are in need of student loans. So, Bill, I'm going to turn it over to you, and we'll kick things off.
Great, thank you very much, and good afternoon, everyone. Again, I am Bill Ayers, and I'm with College Ave Student Loans. And we're going to share some information, as stated, about paying for college, but really to give you a perspective on some of your options. Listen, if you are on the session here today, you are probably considering one of the most important, exciting experiences and decisions of your life. Listen, it's complicated, but at the same time, it really is a very straightforward thing, that being how you plan and pay for college. So we're going to give you some perspective. The most important thing about today is that if you have any questions whatsoever, please ask. It will also give you an opportunity if we don't get to a question, or, and I'll be very honest with you, if I don't have the answer to your question, we'll follow up and we'll get back to you. So this is a relationship that we have with the association, and we really want you to think about us as kind of a go-to source. If there's anything you ever want to know about paying for college, you should think about us and we can help you out. So let's get started here. I'm going to talk a little bit about really what it takes to get started within financial aid. And I'm going to talk about some terms that you may hear: cost of attendance, financial aid, federal loans, private loans. I'll go through the gamut of really the introduction to the whole process, but I'll also give you an idea of what College Ave is all about, whether or not you've heard about us, and to give you also a general idea of federal loans. And you've probably heard a lot about federal loans. Most recently, they're in the headlines, but we are a private loan alternative, and that means that we complement federal loans, so that if you need to borrow money above what the federal loan program can provide to you, that's where we come in. So a little bit about me. I've been doing this being helping people pay for college for about 25 years. I have a lot of experience. I deal mostly with all the colleges and universities around the country, but at the same time, I have the opportunity to talk to folks like you about financial literacy, consumer credit, debt management, and how to really manage your debt so you don't have issues at all with default. And I have to be very candid with you. This is the most enjoyable part of my job. Talking to students, families, parents, really fielding your questions. Every time I do this, someone asks a different question that I haven't heard of before. So I get smarter as well when we do these presentations. So first off, we'd like to know who's on the call with us today. This way I can gauge some of my comments to who's on. So please answer this poll question. Are you a high school student? Are you currently in school? undergraduate, graduate student, maybe a parent of a student, or someone else?
All right, Bill, we have people answering.
Okay.
We've got, it looks like 62% undergraduate, 15% graduate, 18% parent of student, and about 5% other.
Okay. That's good to know. All right, so I will focus then on undergraduate in school as well as graduate experiences, and really start looking at perhaps maybe some of the challenges you've already have faced. So that's
I
very
think
good.
you might need to reshare your screen again. When I did the poll, it closed that out.
Oh, okay, let's see. Okay, reshare. How about now?
I think I might need to change you back to the presenter. Give me a second.
Okay,
Now you're the presenter again. Sorry about that.
that's okay.
All right, you're good.
Are we back? Okay. So, secondly, have you ever heard of a private student loan? Very simple. Again, I mentioned that there are private loans and federal loans. Have you heard about a private student loan before?
All right, we have answers coming in. We'll give people another minute. All right, we have 62% said yes and 38% said no.
Oh, okay. It's good to know then. So, still see my screen, or do you need to?
No, we can see it. I think I figured out the little trick with how we do this.
Okay. So, lastly, have you heard of College Ave before? Yes or no?
All right, we've got answers coming in. We'll give everybody about 20 seconds to get this one answered. It looks like we've got our answers. We have 24% said yes and 76% said no.
All right then. That's good to know. And frankly, having the number as high as 24% is actually good news because we're relatively new in the marketplace. We'll talk about this in a second. We've only really been in the marketplace for about 7 years, which may not seem like a short amount of time, but we are new in terms of just starting since 2014-15. So, but in that short amount of time, we're now the third largest provider in the country, simply just based upon market share. And you probably heard of Sallie Mae. We are the same as Sallie Mae. You probably heard of Discover credit cards. They also provide private student loans. Combined, we are the 3 largest providers in the country, and so we really run the market and know the market probably better than anybody else. So, but it's important to know that. So, really, what has been our claim to fame is this: it's very straightforward. Our application is easy. Our application really deals with what we call a clear and personalized customer experience, and by that I mean, and I'll show you in a little bit, all we do is ask you questions about your needs, and we show you what needs to be done, what you need to choose. We give you a calculator and a pre-qualification tool. It takes about 3 minutes. We do not ask you to set up an account. We will remember you if you come back to us. In other words, if you want to restart an application just based upon our coding. So we won't market to you. Certainly we don't share your information with anyone else. And that really has been our hallmark and why we've become so popular. We are very straightforward, very simple, very transparent. The other thing that we just like to get across is we have really a fabulous blog and really useful financial awareness and literacy materials. And I'll show you those at the end. I'm very sincere when I say this. We'd like to establish a relationship with you. And that is that you, if you need to pay for college, we're there for you. If you need to pay for graduate school or professional degrees further on down the line, I want you to come back to us. And so because of that, we provide a lot of materials that we feel are useful, clear, and very straightforward and very easy to get to, all right? So let's talk about the whole idea of paying for college. There's something called a sticker. It's like buying a car, right? You walk onto a lot, you see a sticker and you go, wow, that costs a lot of money. Well, college is no different. There's something called the cost of attendance, and it's calculated in a very straightforward way. There's tuition and fees, and that's what's billed to you. That's what you're really paying for when you get an education. Those are the academics. You have to think about room and supplies, transportation, how you're going to get back and forth to school, certainly if you travel out of state, and then your personal expenses. So the tuition and fees, that's what you're paying for. The room and board, perhaps you'll live on campus, maybe not. Maybe if you don't live on campus, you'll have to pay rent. Obviously you need books, back and forth, car, plane, what have you. Those last items, those are items that aren't necessarily going to be billed directly by the college university, but the college university understands that you need that money. So they will create a budget for you, very straightforward, and they will include those costs in your budget. So when you get that bill, in it will be enough to subsidize, pay for your year in college. That's the cost of attendance. It's all in, it's everything. However, it's not what you pay. So if you think about it again, that's the top line, that's the sticker. What's deducted from that is your financial aid. And there's something called the FAFSA, which I hope all of you have heard of. It's the application for federal financial aid. And within that application process, there'll be something called a family contribution. The federal government has a method to determine fairly across the board for everyone in the United States how much they should contribute based upon their family situation. It is very unique. Everybody is different. You could have 100 people on this call, and each one of you would have a different family contribution. Why? Because it's based upon how many students from the family are in school, how much money the family makes, how much money the student may make, how much money perhaps you have saved, and it's a calculation. Everybody's different. So once that calculation is made, the government will tell you, based upon the input to the FAFSA application, what your calculation should be. So they take the cost of attendance, that being the sticker, they deduct, they being the school, the family contribution, and out of that, you'll get the bottom line, the financial need. That actually is what you need to then work with the school to think about how much your financial aid will be, right? So if you have a need, the school will provide aid. Each school is different. Why is every school different? Because all the costs are different. And why is everyone's financial need different? So think of it that way. So here's some misconceptions, however, about financial aid. And listen, everyone talks about this with everybody else. You go to the cafeteria, you go to you perhaps meet people at home. Everyone has an idea of what financial aid should be. And here's the thing, everybody's different. And people sometimes say, well, gee, I won't qualify for financial aid. We make too much, we make too little. Never is that the case. You should always fill out the FAFSA to find out exactly how much that could be. You'd be surprised. There are people who think they wouldn't qualify and they do. A lot of people say, well, gee, my income's too high. That's not true. It depends on a lot of the other factors, like I mentioned before, family size being the most important. And then also, my income is too low. I just won't qualify, or I won't even bother going to school. Again, a misconception. So if you don't think you can afford a school, public or private, or you simply think, gee, I can't do it. Maybe I just lost my job and I don't have enough income. That's a misconception. And it's probably the #1 challenge, if you will, for higher education today, and that is to get people to fill out the FAFSA. It's like filling out your income tax. You have to know what really is the balance and where you stand with regard to everyone else. So you fill out the FAFSA. That's the most important thing. And obviously, if a lot of you are already in school, you probably have already done this. Now let's talk about the types of financial aid. So your college university will really approach you in these 4 ways. You can get a grant or a scholarship, or perhaps work in school, or you could possibly even use the federal work-study program, or you may need to borrow money. So right here on this chart, let's look at the first column, grants. Grants and scholarships are free money. You don't have to pay that back. But the difference between, say, a grant and a scholarship is a grant is based upon need. And really, state, local governments, municipalities, the federal government in particular, are very sensitive to how much you need. And the more you need, the more likely you'll be eligible for a grant. Now, is it based upon merit? No. Scholarships are, and by merit it simply means your grades, your academic record. And that academic record could be in high school, or it could be while you're in school, college. So that's merit. That's a scholarship. Again, it's free. It's not based upon need, really, but it's based upon merit. Again, you don't have to pay that back. It's free. So grant scholarship, that's fabulous. If you can go through school on scholarships and grants, congratulations, that's excellent. At the same time, though, you may have other needs. Maybe you just need to have a part-time job while you're in school just to make ends meet within the week or so to buy some necessities. You can have a part-time job. You can be part of what's called the federal work-study program, which really the government helps college and universities pay you for your job. Is it based upon merit? No. Anyone is entitled to participate. It is based on need. In other words, the government will see whether or not you need to have the job paid for by the school, but you don't have to pay that back. So the first 3 columns here, grants, scholarships, and work study, you don't have to pay that money back. However, a loan is a loan. And all of you probably know what that means. And that is that when you do borrow money from any entity, it could be the federal government, or it could be a private loan company like ourselves, a bank, you do need to pay that back. In some cases, it is based upon need, the types of loans. But for the most part, it's based upon your ability to pay it back. And by that I mean, in particular, with a private student loan, we check your credit, which is no different than a credit card, an auto loan, a mortgage, or any other financial instrument that's needed to really gauge what you're able to pay back. Federal loans are not credit-based. Federal loans are really what's called more of an entitlement. You are entitled to that money by the federal government. There are differences, however, between the federal and the private loan programs. So let's talk about that for a second. On the left here are the College Ave private student loan options, and on the right, the federal loans. So here are the distinct differences. Within a private loan, not just College Ave, but most in the industry, will provide you with a variable or fixed rate. The variable rate simply means that your rates change from time to time. The fixed rate means it is fixed. It stays throughout your repayment. Just to perhaps preempt a question, the College Ave rates and many other private student loan rates are based upon what's called SOFR. That is the secured overnight financing rate. So there are indices that we gauge our rates off of, the variable rates. So fixed only for federal, variable rates for private student loans. Auto pay discounts. Any of you, regardless if you take out a loan, credit card, I advise you to always set up your accounts on auto pay. That means every month the money is deducted from your account. You don't have to think about it, and it's simply paid for you directly. And this way you avoid being delinquent. So both federal loans and private loans provide that to you. Repayment terms. Now these are different. And a repayment term is what it sounds like. It's the term by which you'll pay the money back. For College Ave, we give you choices between 5 and 15 years. As a matter of fact, most likely, if you were to take an undergraduate loan, we would give you an option for 5, 8, 10, or 15 years. So you can choose how long or how short you would like to pay that back. The federal government just offers you a 10-year term. Now you think to yourself, why would I want to pay something back in 5 years if I could do it in 15 years? It's very straightforward. If you were to pay back in 5 years, you simply reduce the debt quicker, but here's the key, you pay less interest. So you're gonna be paying more per month, but you get the obligation over with. And in the long run, if you pay off in 5 years, you're simply gonna be paying less because of the interest. If, however, you need to extend it out to say 10 or 15 years, you're paying less by month, but you're paying more interest. So you're just simply drawing out the obligation. It depends on you. It depends on your budget. That's why we give so many choices in the private student loan industry. Credit checks, as I mentioned earlier, yes. With the federal government, no. The federal government will simply provide these loans to you automatically, usually. You can opt out of taking a federal loan, but in all likelihood, your school financial aid office has bundled or packaged these loans already for you. They're very low interest loans. The federal program is an excellent program, but the drawback is that it's capped. In other words, you can only take out so much from the federal government. There are no credit checks as compared to the private loan industry, except for what's called a plus loan, and that's the parents. So what is a credit check? I'm going to talk about this a little bit, but it's important for you to know, let's just say if you're an undergraduate student, this is the beginning of your financial life. The more obligations you have, say credit cards or loans or activity, there is a credit agency that will keep a credit report on you. The older you are, the longer you have finances, the larger your credit report becomes, which is a good thing. And if you are paying on time and managing your debt well, your credit will start to grow and look really good. Ultimately, you'll have a score that will entitle you to have better interest rates, because what the credit industry does is they take a look at you, and what they do fairly is decide what type of a risk you are. If they check your credit report and they see that you have not been paying on time, month in, month out, you're a higher risk. They'll lend you money, but there's a good chance that rate will be higher to mitigate that risk. Now, if you are 17, 18, 19, 20 years old, there's a good chance you simply don't have enough credit at this point in your life for someone to make a decision on you. That's not bad. It just is what it is. So in all likelihood, you'll need what's called a cosigner, and I'll talk about that in a second. A cosigner simply says, you two get together and you both agree to pay back that loan. That's a cosigner. And the reason is because you may not at this point in your life have enough credit. Again, going down the table here, fees. There are no origination fees with private student loans. There are some fees within the federal loan programs, and they vary depending on loan type. Then they could be as low as almost, say, 1.5% up to almost 7% with the Parent Plus loans, as well as some graduate student loans. So a fee is simply a percentage of the overall loan balance. So it could get rather high if you take out a federal loan that has a high balance and a high fee. Fortunately, within the private loan space, there are no fees. Application process, as I mentioned earlier, we have a very straightforward online 3-minute application. You get it over with very quickly, and we'll tell you right away during that application process whether or not you're approved. And the federal student loan application is the FAFSA itself. Simply by filling out that FAFSA application at the beginning of the academic year, you have just, in essence, applied for a federal student loan. Okay, so let's talk about an example here. In many cases, this is an average example, say taking a private school, and then how much perhaps a private student loan would be. How much? What would be the loan balance? And I'm going to jump to the bottom here so I can use this term. We call this the gap, and that is, as I said before, you'll have the sticker, you'll have the cost of attendance. Subtracted from that will be your financial aid, grants, scholarships, and so on, as well as the family contribution, which I told you about, will be determined by the government, and then possibly a federal student loan. As I said earlier, one of the challenges within the federal student loan program is each year there's a cap. So first year student, the cap is $5,500. and then each year it goes up. So if your second year students is 65, third year 75, ultimately there'll be a aggregate cap of say about $31,000 for a dependent student. So because of those caps, there may be a situation where you'll have a gap. So you have the sticker, you subtract out all of your free money, then you subtract out what you may have with a federal student loan, and that gap, what you still owe the school to go through and begin in fall, is what we do. That's what the private student loan industry most likely would be involved in your financial life. We will fund what you need. And as I mentioned earlier, we complement the federal student loan program. You take out a federal loan, anything afterwards, then you come to us in the private student loan industry, and that's College Ave.
Bill, can I make one comment? Do you mind?
Sure.
Will you go
Sure.
back one slide? So
Mhm.
I'm the parent of 2 kids that went through college. And the thing that was always confusing is this line that talks about personal family contribution. That to me was the amount that they expected the family to be able to contribute based on all the things that you fill out in terms of the paperwork. The challenge was always coming up with that money, because even though they tell you that's what you're expected to pay, actually being able to pay it was not always the easy thing. So the gap oftentimes was larger than even what the gap on paper was. So that was my
Right.
personal experience, and I just thought that for people here, that might help them to think about this a little bit differently.
Sure.
Because that's the money you're supposed to be able to pay. It doesn't always mean you have that money to pay it.
Well, it's almost like we planted that question. That's a great real life experience, because if you think about it, it's an algorithm. The government has to start someplace, and they'll make some assumptions that you have this money off to the side. I can tell you that there's a 50-25-25 bit of advice we give people, and that is assume that 50% really, which you'll be able to pay for college, will come from financial aid. 25% perhaps from saving, but 25 other percent will have to come just in time. And that's just it. It may just come paycheck to paycheck. So that last 25% really changes from family to family. But also at the same time, that's where someone may reach out to a family member. There could be other situations where money comes in, but it's such a good point that it's not a given. And it's not like a family can suddenly just snap their fingers and come up with $17,000. So fair point. But to the example here, that's where the gap may increase. So that gap is what we would fund. So we will fund the gap up to the sticker. We'll fund the gap up to the cost of education. So that's good news, and that is, if you need, we'll pay for it. At the same time, and now let's be pragmatic about this, based upon people's credit, debt to income ratios, other things that we need to look at, we will really decide which you're able to pay back. We don't want anyone to get in a situation where they're over their heads. And the other, I guess, safety valve in this is that the school will come back and we need to what's called certify with the school the loan amount. So great real life example there. I appreciate you chiming in. And how did it go, by the way, being a parent of 2? Did you get through this okay?
We did. My daughter graduated with her master's just a few weeks ago, in fact. So I'm all done.
Well, congratulations. That's great. So that's real world, and that's the situation we have to look at. So when we think about private student loans and eligibility, really you hit it on the head. It could be any student pursuing an undergraduate, or in that case, graduate degree. We will fund medical, law degrees, professional degrees. The eligibility could be parents taking out a loan for their students. It could be a guardian. Could be anyone who steps up to society to take out the loan themselves, or be a co-signer, as alluded to before. We really hope that most of our customers would be U.S. citizens, permanent residents. However, we do lend to international students, but we do require that the international student must have a U.S.-based co-signer with a valid Social Security number. The other thing that we do, and it may not be germane to the conversation today, but we do provide refinancing. And what that means is you'll get out of school, you get a job, you're on your feet, you're moving along in your personal financial life, and let's just say you decide you want to buy a home or do something as far as a financial milepost, you may want to refinance your loans. And what that simply means, and I'll explain it later on, is you reset the loan to a different rate, and then we help you do that by providing you with a new loan to pay with the others. So we'll talk about that in a bit. So let's range back to credit here. So another poll question, and again, I just want to get an idea of what the knowledge base is here, but also to have you start thinking about this. This is important. What range do you think your current credit score is? There's no wrong answer here, by the way. Just curious whether or not A, B, C, or D, or E if you don't know. Are we getting some answers?
Oh, sorry, I was on mute. I'm going to go ahead and close the poll. We got our answers.
Okay.
And we have 14% responded A, 23% responded B, 16% responded C, 14% responded D, and the largest 33% don't know.
Okay. By the way, that's the way it should be. Listen, if you're in school right now, I would tip my hat to you if you knew what your credit score is, but most don't. Most students don't, because it's not something you look at every day, and it's not something that really drops into your life. My advice is to everyone on the call, make sure that you have the good habit of checking your credit report. Your credit report, again, as I mentioned earlier, it's a record of all your financial activity. Everything you ever do in your financial life will be on that report. It's extremely important. So even if you may have just one credit card, or you're authorized user, say on a parent's, or you just may have a small loan, it will be on that report. Take a look at it. The simple reason, first off, to make sure there are no mistakes on it. Most of the challenges people have with their credit reports isn't so much this, but it's the information. You'd be surprised how often information on your credit report, it's not going to be drastically wrong. It could have your middle name misspelled. It could have something odd within your address. And the reason there are errors on your credit report, it doesn't happen a lot, but as you go forward in life, it is mind-boggling when you think about this. Every transaction of every lender, of every financial company you've ever been engaged with is piling data into your report. Sometimes they make a mistake. So check your credit report, and then through a bank or a credit card to see what your score is. It's just good baseline. It's like knowing what your pulse or your cholesterol rate is, right? You should know what that is. By the way, I'm not getting any other medical advice. I just thought I'd throw an analogy there. Okay. So benefits of having a cosigner. Let's just say you don't have enough credit to go forward with a loan. This is what happens. If you have a cosigner, in other words, someone who's aligned with you for credit, it vastly increases the likelihood of being approved. So I guess that's the most important thing. It's binary, it's yes or no, can I get a loan out? It will improve your interest rate, and that's big. Let's just say you get approved by yourself, but you have a cosigner who decides to financially stand with you, your interest rate will improve drastically. It also begins to help you establish and build your credit file. As I said earlier, some of you may have much of a credit file and therefore don't have enough for a lender or a finance company to gauge how much of a risk you are. Now you're starting to build credit. Building credit for people in school is so easy. It really is something that if you pay attention to, you manage your debt, you pay on time, establishing credit is very, very simple. Also, I can tell you this, that having a parent or a guardian, someone who knows you very well, serving as a co-signer is probably the most ideal. But you should know about 90% of all private student loans are co-signed. So don't think that it's something that necessarily that's awkward to ask for a co-signer. Most end up being co-signed. Why? Because most students are young and they don't have credit yet. So finishing up here, what College Ave provides, these are the different loans that we have. Undergraduate loans, obviously, undergraduate, graduate. We have loans that are geared specifically for graduate health professions, and that could be nursing in particular. We have loans that are just for parents, and by that I mean a parent can borrow independent of their student and have the obligation themselves. And then we fund medical schools, dental schools, law schools, people who are attending specific MBA schools, as well as loans to students who go to specific career schools. And then I mentioned earlier, we also help with refinancing. So just a knowledge check here. As far as refinancing go, I'm just curious, just a knowledge base, what do you think of loan refinancing right now? So here's the question. Private loan refinancing student debt includes which of the following? Select only one. A credit check, which I told you about, but B, new loan to repay. C, multiple opportunities to refinance, or all of the above. What do you think?
We have our data coming in. Just give it another few seconds. All righty, we'll close the poll. What we have is 3% consumer credit check, 10% answered new loan, 5% answered multiple opportunities, and 82% answered all of the above.
You're a smart group. Always pick all of the above. I always did that. It always worked. But yes, all of the above. Refinancing is a great opportunity to, as I said before, bundle your debt together, especially if you have different loans at different interest rates. They can be replaced with just one loan. And listen, just for the consolidation aspect alone, just dealing with one loan versus many, so think about this once you graduate and you're successful and you're on your feet. So there are some benefits here. You know, we do take not just seriously, but we cherish our opportunity to deal with NSCS members. And because of that, we have benefits that could accrue to you. So if you were to take out a private student loan with College Ave, there'll be a 0.25% interest rate discount off the market rate. Refinancing loans have double that, 50.5% interest rate break. And also we give a 0.25% interest rate reduction when borrowers sign up for auto pay, as I mentioned earlier. And the reason why we do that is very straightforward. It's advantageous to you, but it's advantageous to us. It makes it so much easier for us to process repayments when there is an auto debit set up. So all those discounts accrue to the members within the association. I mentioned before also our financial awareness literacy library. Please take a look at our blog. You can find it easily if you follow along the application link. There's a lot of great information, and we would provide these materials to you. And finally, the process as we go forward, if you were to visit collegeave.com/NSCS, you can get to our application, you select your loan, complete online, and then you'll have the ability to configure your loan. And by configure, I mean, as I said before, you have those repayment term options, but you also have 4 different ways that you could pay off your loan. And that's important to know, that you can defer your loan, you could start paying right away, or you can pay just the interest in school, or you pay what's we refer to a flat pay of $25 in school. Okay, so what's next? What happens is, if you apply a loan for a loan from us, we then handshake back and forth with the school. It's important, again, that the school and us and you agree on what you need based upon your budget, so you don't overborrow. We decide on what's called a disbursement date. That's a date that the school will set up when you need those funds, so they'll help you parse out and budget for yourself. And when that happens, we will disperse the funds directly to the school, and then the school will pay for your tuition fee. It'll go right off the top. You won't even have to worry about it. But then if there are, as I mentioned before, say off-campus fees, money that you need to live, that money will be refunded directly to you. So the school will take out the tuition fees, and then your living expenses, if needed, will be dispersed to you. And as I mentioned here at the bottom, you have 4 ways to pay that off. So this is the landing page. If you go forward and you go through this page, you'll have those benefits that you see here in the lower right made available to you. And this is very straightforward. And this will take you to the application page for any of the loans I mentioned earlier. And if you need to contact us, here are all the numbers. I would say most likely in your cases today would be to help apply for loans. If you need to call someone, it's at the bottom left here. But if you do have a loan with us, you also have access to us, to our servicing arm. And we have chat function, text, everybody else the same, but you can get a hold of us at any point. Okay. I think we're good here. Let's open it up for questions. I know I just threw a lot at you, but please, this is the best part of the whole session. Dealing with.
Well, I've got some questions teed up for you.
Great.
So the first one and I'm going to try to reorder these based on what I think makes the most sense. The first one is, when is the best time to fill out the FAFSA? And then does the student do it or does the parents do it?
That's a great question. Well, it's a great question. I laugh because it is really it's a student obligation. It is your financial life. You should do it. You're the student. Now, let's be honest. Not every student knows the financial situation of their family. So student does it with their parent. But let's be very clear. A parent should not be filling out the FAFSA for the student. Just like a parent doesn't fill out necessarily the tax returns for someone else, right? I mean, it's your finances. You should be signing the document. You should be filling out the FAFSA. So the student does it with help from the parent. I would say as early as possible, usually in October, that's when the FAFSA year starts. Hopefully your high school counselor, if you're in school, high school will tell you, but every year in the fall is when the FAFSA starts. Now, just keep in mind, it's not like first in, first out necessarily. There's a bit of a urban legend about that. Schools will try to accommodate everyone based upon, say, their admission status. If you're already in school, then you don't have to worry about that. But don't delay. You should be doing that in the fall leading up to your spring semester. So you're doing it in effect a year ahead of time.
Perfect. We have a number of questions about interest rates. Obviously, interest rates have been in the news a lot lately, especially with the Federal Reserve hiking their rates by 3/4 of a point yesterday. Can you talk to us a little bit about interest rates and how that impacts what you guys offer?
Okay, it's very straightforward. As I said before, our rates are based upon, it's called SOFR, S-O-F-R. It's the secured overnight financing rate, which is based upon the common rates that the government will set. So just to be very clear about it, there's no magic necessarily to the fact that rates are increasing. Our rates will increase, as will anyone else's. The federal government pegs their rates now for the next coming year, but that's a given. But I would say, without a doubt, interest rates will continue to increase. There's a really good chance that they'll increase again, say, in the next quarter or so. So a lot of people say, well, gee, should I take out a loan now for 2 or 3 years from now? That's a hard equation to really crack, because in effect, we're not going to lend money for loans that have yet to come, because think about it. You only make a loan for what you need today. Now, however, we would, if you take a loan out with us today, in effect, we have a financing guarantee, if you will. If we approve you today and you're with us for several years, there's a high likelihood we'll approve you again. So realistically, our loan rates will increase just as anyone else's.
And are those fixed rates or variable rates?
Good question. So we have both. And I'll just tell you what our rates are right now for undergraduate loan. Our rates at this point are about 1.19% to about 11% APR. And the reason why there's a range is based upon your credit. So the lower credit, the lower interest. I'm sorry, the higher credit, the lower interest. The better your credit is, the lower interest. So there are goalposts. Within those ranges will come your interest rates.
Excellent.
Also have our fixed rate. I'm sorry, I quoted both rates. Fixed rate, the best rate would be about 3.49%, and that goes up to as much as 12.99 based upon credit.
Okay. We got a question, and I think you've generally answered this, but I just want to make sure. So somebody was asking, is this like a loan from a bank, not the government? So I think you've kind of answered that, but wanted to give you the chance to clarify.
It's a great question. When people say student loans, they simply think, well, gee, it's the government. The government will provide just enough, and then we provide what's on top of that. So if you were to borrow through College Ave, and with our association here, it would be a private loan. So it comes from a bank. It comes from a private company versus the federal government. They complement each other. So we are the private side, and then there's the federal side. So it's different.
Somebody is asking, this is an individual question, but I think it can be related to multiple people. They have multiple children in school. Do they take out one loan for both of them, or are the loans individual?
Great question. That's an excellent question. So a loan is by student, and that will be for the federal government as well as the private entity like ourselves. Because if you think about it, what you're doing is you're buying the education for that individual student. And then also what makes it a little easier perhaps in your case, if you have multiple children, your estimated final contribution will change. The more kids you have, the contribution will be different. So because of that, then you're entitled to more financial aid, and you're entitled to more financial aid based upon the number of students you have in your family. And because of that, the gap will shrink. So you'll in all likelihood be entitled to more money, more financial aid. But that's a really good question. People in some way their minds think, well, it's my family. No, you buy education by student.
Excellent. So we have one here that I think is going to help, again, with understanding the various ways of funding education. Somebody's asking if you could clarify what's the difference between a subsidized loan, an unsubsidized loan, and work study?
Really good question. So when you hear about unsubsidized loans versus subsidized loans, the difference really comes down to how the interest is determined, and that is within the federal government. So what the government will do is they will say for a certain amount, they will pay the interest, right? So subsidized loans are available to undergraduate students. So the government will pay, they'll subsidize that interest. An unsubsidized loan is above and beyond that, and that's where the government doesn't pay interest. So those loans are a little more costly. So the most important thing to remember is that the government will combine the two. And as I mentioned also earlier, there is a limit that the government will pay. So let's just say for a dependent student, see if I remember, we have about $31,000 would be available to a undergraduate student. No more than $23,000 of that may be a subsidized loan. All right, so the government will mix and match depending on your dependency. But that's a great question. Work study is a program where each college university gets a set work study amount. And that amount then they'll divvy out amongst the students. And you can have a large university, they've got millions of dollars of work study funding for them. And then they'll if a student comes into the financial aid office and say, gee, I'd like to get a job, most likely that would be a federal work study job. But the school may take a look at the need that's generated from the FAFSA to see whether or not they can use that federal money. In most cases, federal work study is eligible for everybody. Two really good.
Yeah, somebody here is saying, you were talking about your credit report. They were saying that they remember hearing from someone that checking your credit report can actually hurt your score. Is this true?
I scream when I get asked that question. It's one of the myths. We do a lot of credit counseling as well. It is probably the biggest myth you could think about with credit. There's no reason why you can't check your score. And if anything, because of the pandemic and what's called the CARES Act, the federal government has set up so consumers can get access to what's called freecreditreport.com. They can check it every week. Now, don't obsess about your credit. I know people who every single day check their credit score, which is nonsense, but you should check it as often as you feel comfortable doing. Checking it once a month is fine. It doesn't hurt your credit at all. Now, what is true, and again, a little bit of an urban legend here, people say, well, gee, if I shop, if I go try to buy a car over the weekend, if I have my credit checked, what's called a hard decline, which means someone will actually look at your credit. If that happens too often, that may be an issue. But the credit world understands the fact that you're shopping. So if you go to shop for a car over a weekend and you go to 4 dealers and you have 4 finance companies check your credit, they know that. The credit world knows that. And this way you'll only have one inquiry. There's nothing wrong with that. Same thing goes with student loans. If you decide to go out and get a student loan and check your rate against somebody else's, the credit world knows that, and they'll only have one pull. So what's called hard pulls, usually about 1. Soft pulls, in particular you looking at your credit, there's no issue with that whatsoever. So have at it. Check your credit as often as you like, but that makes you happy.
Great question here. Do you have to have a federal student loan to then pursue a private student loan?
No, you don't. Again, a very good question. It's not sequential. Some people decide simply not even to take advantage of federal funding, and they like to fund it on. This is a family choice. Go directly to us or any other private lender and go directly without even having to fill out a FAFSA. And some people like that. They'd rather just do things their own and not get federal resources involved, and that's fine. So no, there's no coupling and it's not dependent.
Okay. Lots more questions here. Some are very specific. So
Okay.
I'm going to try to work through this. We have a parent here who says they got a loan last year, great credit score. Their financial circumstances are essentially the same. We applied for a new loan for this year and rates have doubled. Is that correct?
Well, I'm going to speak in general terms. If you took out a loan last year and your credit score was X and your amount was Y, you should know that that loan you took after year 1 is now on your credit report. Therefore, your debt to income ratio has changed a little. So that shouldn't double your interest rates necessarily. A lot of factors go into your score. I think it's important for you at the point in time when you take out a loan to see what that score is. Not say there's a straight line interpretation to, my score is this, therefore my rate should be that. A lot would change, but what you're telling me doesn't surprise me because people's financial situations change from year to year. Doubling it, yeah, that would be tough to swallow. Frankly, I would be surprised myself, but it doesn't surprise me to hear from one year to the next that your debt may have increased because you already took out a previous loan. If, however, you take out the loan with the same company, obviously they have a relationship with you. I don't think that those rates would double. And if they do, you should call them.
Yeah, we know rates are up because of, the economy and things changing, but that does sound like a lot year over year. There's a couple of other questions here I'll give you a chance to respond to. One is saying that, and they're, maybe similar. This person's saying it can get a better rate from their bank. Why should they go with College Ave? And then the other question is, what sets you apart from Sallie Mae and Discover?
Oh, I love that question. Okay, I'll answer the first. So I'll approach that in two ways. There's secured credit. In other words, let's just make it simple. It's a credit card. If you were to go to a bank and say, I'd like to have a credit card of $1,000, and they look and they see in your account you have $1,000, that's secured. You'll always get a better rate. So if your bank knows you have a certain amount of money on file with them, it could be savings accounts, it could be brokerage accounts, you will always get a better rate. Now, because of, say, a relationship with someone like us, if you don't have an account with us per se or relationship, then the risk profile is different. So we'll be conservative, and we would not be able to match a rate with a secure account that you have from a bank. I'd always go to a bank if I were you. But then that's the triage, right? I mean, that's where you have to say, gee, if I take the money from here, can I use it someplace else? It depends. I mean, if I'm not trying to give financial advice here, believe me, but if you can keep the money at your bank at a higher interest rate or equal to what you'd be borrowing from us, that is a decision you have to make. But a bank will always be able to give you a better rate. Now, as far as the other question, you know, I get asked this question all the time, so it's my pocket song, right? If you play the piano, you walk into a room, you should have one song you always play. We are a one-trick pony. This is all we do. All we do is private student loans. We're not distracted by credit cards or anything else. So this is our only business. So we're really good at it. The other thing that makes us very, very different is our application process. If you're taking an application with others, it's onerous. And there's a high likelihood they'll ask you for account information. We don't sell any of that information. And our rates, I can tell you, between Discover and Sallie Mae, we check them constantly. They're all competitive. We're pretty nerdy about that. We probably check the competitive rates 2 or 3 times a day. So the rates are the same. So it's process.
And I guess I will chime in to say, look up the reputation and the experience that people have had with these companies. Some of them are well respected and well thought of, and some of them aren't. And I guess I'll leave it at that. We just have time for one more question here. I want to jump into this particular one because I think that this is probably for a lot of people, and it maybe relates a little bit to what I said earlier. For undergraduate or graduate school, the cost of living is completely unrealistic. Suggestions for students who need to borrow more money than the cost of attendance.
Great question. Okay, so I know this is quick, but establish a relationship with your financial aid office. Walk into the office and sit down and get to know them. And if you have to do it virtually. You can appeal really what your off-campus living situation is. Every school will have a formula, and that is if you take an apartment down the street, they have a general idea. But if you can walk into the financial aid office with your bill and you say, this is how much my rent is, I'm sharing my apartment with 18 people, I'm sorry, this is the best as I can do, establish a relationship and show them specifically what your costs are, and then they can work out the budget. Because ultimately, they will be the decider of how much your budget should increase or decrease it based on your living expenses, and then we go back and forth. But you can negotiate clearly with your financial aid office about those fees. And yes, sometimes it's unrealistic because they don't know your situation. Inform them and tell them.
Bill, I want to thank you for Sarah and Coleman and Jocelyn and Tyrell and Julie. I'm sorry, we're not able to get to your questions right now. If you would like, you can email those to us and we would be happy to pass those along. You can also reach out directly to College Ave. But Bill, on behalf of NSCS, I really want to thank you. This has been very informative. Hopefully all of our members here, and for those of you that are watching this recording, this has been great information for people to figure out what their student loan options really can be and should be. So thank you very much.
Okay, and please, for those we didn't get questions, please email those questions and we will get back to you right away with answers. I promise you that. Okay?
Excellent. Well, thank you, everybody. On behalf of NSCS, we hope you guys enjoy the rest of your day. And this recording will be available, and we will email out a link probably sometime tomorrow and you'll be able to access this through Scholar Central as well. So thank you, everybody, and we look forward to seeing you at the next event. Thanks, Bill.